ParthKuchana.com, complete fundamental and technical analysis of stocks and other financial industry updates. Hello, welcome to Partha Kuchana Finance channel. This video provides complete fundamental analysis of Maruti Suzuki India Ltd Maruti stock. Disclaimer: this analysis is for educational purpose only. This is not financial or investment advice. Make financial and investment decisions on your own. Valuation. Let's focus on assessing return on capital, equity efficiency, overall pros and cons, and valuation and calculation of key ratios and interpret them. This is based on market cap, current price, high-low, ROCE, ROE, P/E ratio, book value, face value, financial ratios data. Fundamental analysis of Maruti stock. 1. Return on capital employed, ROCE. Current ROCE, 23.7%. Historical context: ROCE has varied from 15% to 24% over the past years, showing strong capital efficiency. The current ROCE of 23.7% is a significant improvement, indicating that Maruti is effectively utilizing its capital to generate profits. This is well above the industry average, reflecting superior operational efficiency and effective use of capital. 2. Return on equity, ROE. Current ROE, 18.3%. Historical context: ROE has been as high as 24% and as low as 6% in the past. The current ROE of 18.3% is an improvement compared to the recent historical lows but still slightly lower than its historical highs. A robust ROE indicates strong financial performance and effective management of shareholders' equity. 3. Price to earnings, P/E ratio. Current P/E ratio, 26.1. Valuation context: the P/E ratio is a measure of how much investors are willing to pay for each rupee of earnings. A P/E ratio of 26.1 suggests that the stock is trading at a premium compared to its earnings. While a higher P/E ratio may indicate positive growth expectations, it also suggests that the stock might be overvalued relative to its earnings, especially when compared to industry peers. 4. Book value. Current book value per share, 2,724 rupees. Stock price versus book value: the stock is trading at approximately 4.48 times its book value. This indicates that investors are paying a premium over the book value, reflecting high growth expectations and confidence in the company's future performance. However, a high price-to-book ratio can also signal potential overvaluation. 5. Face value. Current face value, 5 rupees. Context: the face value represents the nominal value of the stock. Maruti's face value is relatively low compared to its market price, which is common for established companies with high market valuations. Pros and cons. Pros. Strong ROCE. Maruti's high ROCE of 23.7% demonstrates effective use of capital and superior operational efficiency. Healthy dividend payout. The company maintains a healthy dividend payout of 36.3%, providing attractive returns to shareholders. Debt management. Maruti has successfully reduced its debt, contributing to a stronger financial position. Cons. High P/E ratio. The stock's P/E ratio of 26.1 suggests it may be overvalued compared to earnings, which could be a concern for value investors. Premium to book value. Trading at 4.48 times its book value indicates that the stock may be overpriced relative to its underlying book value. Conclusion: Maruti's strong ROCE and ROE reflect effective capital management and operational efficiency. However, the high P/E ratio and premium over book value suggest that the stock might be overvalued. Investors should weigh these factors when considering the stock's potential, keeping in mind its strong performance metrics and healthy financial management. Financial health. Let us focus on financial health and leverage analysis. Review asset and liability management and equity changes. This is done focusing on assets, liabilities, equity, key metrics from the balance sheet over the last several quarters. Balance sheet analysis of Maruti. 1. Assets. Total assets. Maruti's total assets have shown a significant increase from 27,517 crore rupees in March 2013 to 1,15,353 crore rupees in March 2024. This growth indicates robust asset accumulation, likely driven by business expansion and investments. Fixed assets. Fixed assets increased from 10,022 crore rupees in March 2013 to 28,095 crore rupees in March 2024, highlighting substantial investments in property, plant, and equipment. This growth underscores Maruti's focus on expanding its production capacity and operational infrastructure. CWIP. Capital work in progress. CWIP saw a notable rise, particularly from 2,904 crore rupees in March 2022 to 7,504 crore rupees in March 2024. This suggests ongoing large-scale projects and future capacity enhancements. Investments grew from 7,421 crore rupees in March 2013 to 57,296 crore rupees in March 2024. This increase reflects Maruti's strategic investments in various assets, likely enhancing its long-term growth prospects. Other assets increased from 8,107 crore rupees in March 2013 to 22,457 crore rupees in March 2024. This growth indicates a rise in receivables or other non-fixed asset investments. Liabilities. Total liabilities have surged from 27,517 crore rupees in March 2013 to 1,15,353 crore rupees in March 2024. This significant rise suggests increased borrowing and other financial obligations to support the company's growth. Borrowings have fluctuated over the years, with a notable decrease from 1,569 crore rupees in March 2013 to 119 crore rupees in March 2024. This decline indicates a reduction in debt or improved repayment capacity. Other liabilities rose from 6,920 crore rupees in March 2013 to 29,598 crore rupees in March 2024, reflecting increasing operational or financial commitments. 3. Equity capital remains stable at 151 crore rupees until March 2024, with a recent increase to 157 crore rupees. This minor increase suggests that Maruti has opted for incremental equity infusions rather than significant capital raising. Reserves grew substantially from 18,877 crore rupees in March 2013 to 85,479 crore rupees in March 2024. This indicates strong retained earnings and a solid cushion for future financial stability. 4. Financial health and leverage. Asset management. Maruti has effectively managed its asset base with a substantial increase in total assets, fixed assets, and investments. This growth reflects strategic investments in expanding its operational capabilities and future potential. Liability management. The rise in total liabilities, despite the significant reduction in borrowings, suggests that the company may be relying more on other forms of financial obligations. The increase in other liabilities warrants attention to ensure it is aligned with asset growth. Equity and reserves. The growth in reserves, alongside stable equity capital, indicates a strong financial position with increased shareholder value. The reserves growth is particularly notable, providing a robust buffer against potential financial fluctuations. Conclusion. Maruti's balance sheet shows a company in a strong growth phase, with significant asset accumulation and strategic investments. The increase in total liabilities is offset by reduced borrowings, indicating improved debt management. The substantial growth in reserves reflects solid financial health and confidence among investors. Overall, Maruti demonstrates effective asset and liability management, maintaining a healthy leverage ratio and ensuring long-term financial stability. Cash flows from financing activities. Now let's look at the trend and interpretation of cash from operating activities, cash from investing activities, cash from financing activities, net cash flow. This is done focusing on cash flow data over the last several quarters. Cash flow analysis of Maruti. 1. Cash from operating activities. Trend. Maruti's cash from operating activities shows a generally positive trend, with a notable increase from 4,059 crore rupees in March 2013 to 16,801 crore rupees in March 2024. There are fluctuations, with significant drops in March 2021 and March 2022, but the overall trajectory is upward. Interpretation. This consistent growth indicates that Maruti has been increasingly effective in generating cash from its core business operations. The improvement in recent years, particularly in March 2024, suggests stronger operational efficiency and profitability. 2. Cash from investing activities. Trend. Cash flows from investing activities have been consistently negative, reflecting substantial outflows for investments. This trend, with amounts ranging from -3,119 rupees crore in March 2013 to -11,865 rupees crore in March 2024, shows significant investments in fixed assets and other capital expenditures. Interpretation. The persistent negative cash flow from investing activities indicates that Maruti is heavily investing in its growth and expansion. This is common in growing companies that are reinvesting their earnings into long-term assets. 3. Cash from financing activities. Trend. Cash from financing activities also shows a negative trend, though with varying magnitudes, from -979 rupees crore in March 2013 to -4,062 rupees crore in March 2024. This suggests that the company has been using more cash for financing activities than it has been receiving. Interpretation. The negative cash flow from financing activities typically indicates that Maruti is repaying debts or paying dividends, and possibly facing higher financing costs. The increase in outflows in recent years could indicate rising financial obligations or decreased inflow from financing sources. 4. Net cash flow. Trend. The net cash flow has been volatile, with negative values in several years and a significant positive shift to 874 crore rupees in March 2024. This volatility suggests periods of cash shortages and surpluses. Interpretation. The recent positive net cash flow indicates improved overall liquidity and a stronger cash position. The large increase in March 2024 reflects successful management of operating cash flows and investment strategies. Pros and cons. Pros. Strong operating cash flow. Maruti's consistent increase in cash from operating activities reflects robust business performance and operational efficiency. Positive net cash flow in recent year. The significant improvement in net cash flow in the latest period indicates a stronger liquidity position and effective cash management. Cons. Negative investing cash flow. Persistent negative cash flow from investing activities suggests high capital expenditure, which, while indicative of growth, also signals substantial financial commitment. Negative financing cash flow. Ongoing negative cash flow from financing activities indicates possible higher debt repayments or reduced inflows, which could affect financial flexibility. Conclusion. Maruti's cash flow analysis reveals a company investing heavily in growth with substantial operating cash generation. While the negative cash flow from investing and financing activities points to high capital expenditure and debt repayments, the overall improvement in net cash flow, particularly in recent years, suggests effective cash management and a strong operational performance. The company's ability to generate substantial cash from operations and manage investment outflows effectively positions it well for sustained growth and financial stability. Revenue trends, profit margins, expense management. Let us now focus on revenue trends such as growth or decline, seasonality. Profit margins, like gross profit margin, operating profit margin, net profit margin, and expense management. Fundamental analysis of Maruti. 1. Revenue trends. growth, Maruti has shown a consistent upward trend in revenue over the past decade, from 44,304 crore rupees in FY 2013 to 145,103 crore rupees in FY 2024. This indicates strong growth and increasing market demand for its products. Seasonality. There is no significant seasonality evident from the annual data, as the growth trend is steady year over year. 2. Profit margins. Gross profit margin, OPM%, operating profit margins have fluctuated between 7% and 16% over the years. A peak of 16% in FY 2016 suggests strong profitability during that period, while recent years show a decline to around 9% in FY 2022 and recovery to 14% in FY 2024. Operating profit margin, OPM%, the margin has shown variability but remains robust, reflecting the company's ability to manage operating expenses efficiently despite changing revenue. 3. Expense management. Operating expenses have increased in line with revenue, reflecting a growing scale of operations. The ratio of expenses to sales has been relatively stable, indicating effective cost management. Cost of goods sold, COGS. As expenses rise, COGS also increases, but the operating margin suggests that Maruti manages its costs well to maintain profitability. 4. Earnings before interest and taxes, EBIT, and earnings per share, EPS. EBIT trends. EBIT has increased significantly from 4,361 crore rupees in FY 2013 to 20,085 crore rupees in FY 2024. Demonstrating effective cost control and strong operational performance. EPS trends. EPS has shown significant growth from 81 rupees and 74 paise in FY 2013 to 472 rupees and 62 paise in FY 2024. This substantial increase reflects improved profitability and shareholder value. 5. Profitability ratios. Return on equity, ROE. The company maintains a high ROE, which indicates effective utilization of shareholders' equity to generate profits. Return on assets, ROE is also strong, suggesting that Maruti efficiently uses its assets to generate earnings. 6. Exceptional items and non-recurring costs. Impact. The data does not explicitly mention exceptional items or non-recurring costs, but the steady increase in net profit suggests that such items, if present, have been managed without significantly affecting overall profitability. Impact on company stability. Revenue consistency. Maruti's revenue has been consistently increasing, showcasing stable growth and strong market presence. Profitability analysis. Profit margins have experienced fluctuations but have generally remained healthy, indicating effective expense management. Earnings trends. The consistent growth in EBIT and EPS underlines robust earnings growth, enhancing company stability and shareholder value. Conclusion. Maruti demonstrates strong financial health with consistent revenue growth, effective cost management, and robust profitability. The significant increase in EBIT and EPS over the years reflects its ability to enhance shareholder value and maintain stability despite market fluctuations. The company's profitability ratios further underscore its effective operational management and financial stability. Overall performance, growth trends, profitability, and operational efficiency. In this section, let us focus on highlighting overall performance, growth trends, profitability, and operational efficiency. Provide insights into the company's financial health and potential future outlook. This is done based on trends and growth, profitability and margins, operational efficiency, profit before and after tax, earnings per share, EPS, details from quarterly earnings reports over the past several quarters. Quarterly earnings analysis of Maruti. 1. Trends and growth. Sales growth. Maruti's sales have shown a steady upward trajectory from 17,776 crore rupees in Q1 FY 2022 to 35,779 crore rupees in Q1 FY 2025. The company experienced notable growth in the latest quarters, with a peak of 38,471 crore rupees in Q4 FY 2023. This consistent growth indicates strong demand and successful expansion strategies. 2. Profitability and margins. Operating profit margins, OPM%. The operating profit margin has fluctuated between 4% and 14% over the quarters. The most recent quarters show a high margin of 14%, reflecting improved operational efficiency and profitability. This variability suggests the company has managed to enhance its margins in recent quarters, despite earlier lower performance. 3. Operational efficiency. Operating profit has seen significant improvement, growing from 819 crore rupees in Q1 FY 2022 to 5,107 crore rupees in Q1 FY 2025. This reflects a substantial increase in operational efficiency and effective cost management. Expenses have increased in line with sales but have been managed efficiently, as evidenced by the improved operating profit. The recent quarter's expenses of 30,673 crore rupees are well aligned with the revenue increase, indicating effective cost control. Depreciation has been relatively stable, with a slight increase to 1,332 crore rupees in the latest quarter. This indicates steady asset utilization and capital investments. 4. Profit before and after tax. Profit before tax, PBT has shown strong growth, increasing from 596 crore rupees in Q1 FY 2022 to 4,836 crore rupees in Q1 FY 2025. This consistent increase reflects robust operational performance and revenue growth. Net profit has also demonstrated significant growth, from 475 crore rupees in Q1 FY 2022 to 3,760 crore rupees in Q1 FY 2025. The improvement in net profit is partly due to higher PBT and effective tax management, despite the fluctuating tax percentages. 5. Earnings per share, EPS. EPS trends. EPS has experienced notable growth, from 15 rupees and 72 paise in Q1 FY 2022 to 119 rupees and 58 paise in Q1 FY 2025. The recent quarters show significant increases, reflecting the company's strong profitability and effective management of shares outstanding. Conclusion. Maruti has demonstrated robust financial performance with consistent growth in sales, operating profit, and EPS. The recent quarters reflect improved operational efficiency and strong profitability, with higher OPM and substantial increases in net profit and EPS. The company's ability to manage expenses effectively and enhance margins indicates strong financial health and positive future outlook. Overall, Maruti's quarterly performance highlights its strong market position and efficient operational management. Company stability and competitive positioning. In this section, focus is on current market price positioning, price to earnings ratio, PE, valuation comparison, growth expectations, market capitalization, size and stability, investor confidence, dividend yield, dividend %. Income generation, company strategy, net profit, profitability comparison, profit trends, quarterly profit variation, growth volatility performance trends, sales, revenue scale, revenue consistency, quarterly sales variation, sales growth, market trends, return on capital employed, ROCE %, efficiency and profitability comparative performance, compared to peers in the same industry. Comparative analysis of Maruti with industry peers. 1. Current market price, CMP. Maruti, 12,200 rupees and 85 paise. Peers, M&M, 2,678 rupees and 95 paise. Mercury EVTech, 69 rupees and 68 paise. Hindustan Motors, 35 rupees and 5 paise. Analysis. Maruti's CMP is significantly higher than its peers, indicating a higher market valuation and potentially greater market confidence or premium valuation compared to the industry. 2. Price to earnings ratio, PE. Maruti, 26.09. Peers, M&M, 30.17, Mercury EVTech, 614.68, Hindustan Motors, 28.77. Analysis. Maruti's PE ratio is lower than Mercury EV Tech but higher than M&M and Hindustan Motors. A lower PE compared to Mercury EV Tech suggests a more moderate growth expectation, while a higher PE than some peers indicates potential growth prospects or a premium valuation. 3. Market capitalization, Marcap. Maruti, 383,597.86 crore rupees. Peers, M&M, 333,135.16 crore rupees, Mercury EV Tech, 1,223.21 crore rupees, Hindustan Motors, 731.35 crore rupees. Analysis. Maruti has the largest market capitalization among its peers, reflecting its dominance and stability in the industry. This large market cap also suggests a high level of investor confidence. 4. Dividend yield. Maruti, 1.02%. Peers, M&M, 0.79%, Mercury EV Tech, 0%, Hindustan Motors, 0%. Analysis. Maruti's dividend yield is higher than that of M&M and its other peers. This indicates that Maruti is relatively more focused on returning value to shareholders through dividends. 5. Net profit, NPQTR. Maruti, 3,759.70 crore rupees. Peers, M&M, 3,545.78 crore rupees, Mercury EV Tech, 0.23 crore rupees, Hindustan Motors, 16.10 crore rupees. Analysis. Maruti's net profit is the highest among its peers, reflecting strong operational performance and market position. 6. Quarterly profit variation, QTR profit VAR percent. Maruti, 47.85%. Peers, M&M, minus 6.50%, Mercury EV Tech, minus 23.33%, Hindustan Motors, 6,608.33%. Analysis. Maruti shows high quarterly profit variation, indicating potential volatility in earnings. This is in stark contrast to M&M and Mercury EV Tech, which have negative growth, and Hindustan Motors, which shows extreme variation. 7. Sales QTR. Maruti, 35,779.40 crore rupees. Peers, M&M, 37,217.72 crore rupees, Mercury EV Tech, 5.57 crore rupees, Hindustan Motors. Data not available. Analysis. Maruti's sales are competitive, although slightly lower than M&M's. This large scale of sales demonstrates Maruti's strong market presence. 8. Quarterly sales variation, QTR sales VAR percent. Maruti, 9.97%. Peers, M&M, 9.81%, Mercury EV Tech, minus 20.31%, Hindustan Motors, 200.79%. Analysis. Maruti's sales growth is comparable to M&M and significantly better than Mercury EV Tech. This suggests steady growth in sales performance. 9th. Return on capital employed, ROCE. Maruti, 23.68%. Peers, M&M, 13.58%, Mercury EV Tech, 2.96%, Hindustan Motors, 200.79%. Analysis. Maruti has the highest ROCE among its peers, indicating superior efficiency in utilizing capital to generate profits. Conclusion. Maruti stands out among its peers with the highest market capitalization and net profit, reflecting its strong market position and operational efficiency. Its PE ratio and dividend yield suggest a solid valuation and focus on shareholder returns. However, the high quarterly profit variation indicates some level of earnings volatility. Overall, Maruti's superior ROCE and competitive sales performance reinforce its strong industry position and financial health. Changes in promoter, FIIs, DIIs, government, and public shareholding. In this final section, let us evaluate the company's ability to generate cash and manage its financial obligations. With focus on changes in promoter, FIIs, DIIs, government, and public shareholding with the objective of evaluating stability and investor confidence. Shareholder pattern analysis of Maruti stock. 1. Promoter shareholding. Current shareholding 58.19%. Trend. Promoter shareholding has increased slightly from 56.37% to 58.19% over the past years. This indicates a stable and slightly strengthening commitment from the promoters, suggesting confidence in the company's future prospects and a controlled management of ownership. 2. Foreign institutional investors, FIIs. Current shareholding 18.98%. Trend. FII shareholding has decreased from 22.52% to 18.98% over the last few years. This decline may suggest a reduction in foreign investor confidence or a reallocation of investments. The decreasing trend could indicate a shift in investment strategy or concerns about the stock's valuation or market conditions. 3. Domestic institutional investors, DIIs. Current shareholding 19.37%. Trend. DII shareholding has seen a moderate increase from 15.98% to 19.37%. This rise indicates growing confidence and interest from domestic institutions, reflecting a positive outlook on the company's performance and stability. 4. Government shareholding. Current shareholding 0.07%. Trend. Government shareholding remains minimal and relatively stable, with a slight increase from 0% to 0.07%. This negligible presence suggests limited direct government involvement or ownership in the company. 5. Public shareholding. Current shareholding 3.41%. Trend. Public shareholding has decreased from 5.13% to 3.41%. This decline might reflect a reduction in retail investor participation or increased institutional ownership. Lower public shareholding can impact liquidity and market volatility. 6. Number of shareholders. Trend. The number of shareholders has decreased from 4,63,718 to 3,89,314. This decline could be due to various factors such as consolidation of shares or reduced retail investor participation. Summary. Maruti's shareholding pattern indicates stable promoter control with a slight increase in their stake, suggesting confidence and stability in management. The decrease in FII shareholding might reflect a cautious outlook or a shift in investment preferences, while the increase in DII shareholding points to growing confidence from domestic investors. The minimal government shareholding implies limited state involvement, and the decline in public shareholding could impact stock liquidity. Overall, Maruti appears to have a stable and controlled ownership structure, with a notable shift towards domestic institutional interest. The company's ability to generate cash and manage financial obligations appears robust, given the stable promoter stake and increased institutional support. Thank you for watching. If you like this analysis, please like, share and subscribe. Also, do not forget to visit parthakuchana.com.